And I would suggest that the beneficiary of this, once that arithmetic comes to be felt in the market, will be first in the gold market. I think in the near term, and I define the near term as a year, gold. Gold, in my experience, has done particularly well when people are concerned about the maintenance of purchasing power in their domestic currency. This Fed decision is really interesting. We're told we have a great economy, and the equities market would suggest we have a great economy. If we have a great economy, why do we need a 50 basis point rate cut? That's of interest to me. A broader topic, I think, Michael, around gold is the fact that if you believe, as I do, that the gold price does well when people are concerned about the maintenance of purchasing power in fiat-denominated instruments, let's do a little bit of arithmetic. The government would have you believe that inflation, their measure of the deterioration of the purchasing power of the U.S. dollar, according to the CPI, is cruising along at 2.6. If you believe that, earning 4.2, 4.3, or now 4 in the U.S. 10-year Treasury isn't a bad deal. You get paid 4% real yield in a currency depreciating by 2.6% a year. You get a positive real yield. I don't believe those numbers, Michael. I do a thought exercise every year, and I have for 6 years, around the pricing of the basket of goods and services that I consume in my life. The government, when it's inconvenient, doesn't include food or fuel. Unlike you, Michael, I'm not on a fast. So the price of food is of some import to me. Importantly, the government number in the CPI doesn't include the cost of government itself, while tax is usually the largest component of every household budget, every working family in the United States. If you believe, as I do, that the deterioration of the purchasing power of the U.S. dollar is more like 7.5 than it is to 2.5, then the fact that you're getting paid 4% on your 10-year Treasury, on your deposit products, in a currency that's depreciating by 7.5% means that the money that you're saving is losing you 3.5% a year in purchasing power. There is nothing in the world that would cause me as much concern about the deterioration of my purchasing power as that simple piece of math. Cutting the reference rate, cutting the Fed rate, cuts the yields on other savings deposits, while at the same time likely increasing the deterioration of the currency in real terms. And I would suggest that the beneficiary of this, once that arithmetic comes to be felt in the market, will be first in the gold market. And I'm going to attempt to answer it. I would note that I'm a credit analyst, not a social psychologist. So my answer is going to be necessarily dry. I came into the business in the decade of the 70s, and the circumstance that confronts us now confronted us in 1968 when I was a little too young to understand it. But it was pretty clear after having fought the war in Vietnam and the war on poverty that we had more obligations as a society than we could service. It became fairly obvious, too, that we couldn't raise tax to cover the net present value of our obligations. So what we did in the period 1970 to 1981 is that we reduced the purchasing power of the dollar through inflation by over 80% in 11 short years. The consequence of that is that the gold price, of course, went from a price-controlled $35 an ounce, to a price in excess of $800 per ounce. What's germane to the question is that the writing was on the wall around inflation beginning in 1968, but it didn't become a matter of popular concern until 1972 or 1973. If you dial back to that circumstance, if you dial back to those days, we had experienced very, very, very buoyant economic conditions from the end of World War II, say 1946. All the way through 1968. The Nifty 50 is an example, the wonderful growth of American hegemony around the world, the strength of the U.S. dollar, and people were conditioned to be optimistic. I would suggest that we have lived through an even longer and even more beneficent circumstance from 1982 to 2022. Wonderful strength in the U.S. dollar, wonderful equity markets, wonderful bond markets, a lot of animal spirits, people being trained to buy the dip, people not being afraid. I personally believe that this beneficent epoch that we enjoyed, this 4-decade epoch, came to an end in 2022. And I personally believe that there will be a lag in psychology from a psychology of boom to a psychology of caution. By the way, I'm not calling for the Greater Depression. I'm not calling for the end of the US dollar. I'm not doing all that doom and gloom stuff. All I'm saying is that there is going to be a reckoning as a consequence of the obligation that our society favors. And that reckoning, I think, almost necessarily results in the continued and accelerated depreciation of the purchasing power of the US dollar, and increasingly, too, a recognition of the benefits of gold, a recognition that we last saw to this extent in 1970 to 1982, but we also saw in fairly dramatic form in the period 2000 to 2012. Well, price controls really has a track record unblemished by success.
Yeah.
If you look back to markets where they had price controls, what you ended up having was a supply control. You also had a diversion of revenue from the people who could increase supply, which is to say private industry, to those who always constrained supply, which is to say the U.S. government. It may be that price controls become popular again. I don't know. My hope is that an examination of history will cause even our political elites to be less stupid in the future than they have been in the past. I've never seen price controls work. Let's look at New York City, the consequence of rent controls. Slums, underinvestment in rental construction, a lack of availability of rental accommodation, a track record, as I say, unblemished by success. Successful, of course, for those people who were able to obtain rent-controlled units in the 1970s and 1980s and enjoy substantially below market rents today at the expense of the broader community. Price controls never work. Markets always work. The cure for low prices is always low prices. The cure for high prices is always high prices. But markets are messy. They take time. Markets have victims. Markets have beneficiaries. The victims are always covetous of the beneficiaries. The victims are also more numerous and they vote. I am not buying silver bullion. I have a fairly large position in gold bullion. By the way, I'm stupid to do that. I'm the largest shareholder of Sprott Inc. And if the gold market and the silver market run, in theory, the most important brand name for retail investors in gold in North America is Sprott, I will do well. But I own gold bullion because it helps me sleep nights. And at age 71, that's a real benefit. I do own silver stocks. And I own silver stocks because towards the middle of a gold bull market, through the end of the gold bull market, historically, there is no asset class that performs as well to the upside as the silver stocks. The population of legitimate silver stocks is very small, and their combined market capitalizations are very small. 4 times before in my career, the precious metals narrative has been such that the generalist investors go first into the gold equities, but later into the silver equities, and the combined market capitalizations of the silver equities, we'll call that the silver silo, is so small that it can't handle the influx of capital that comes in. And the results can be very dramatic, Michael. I remember in the decade of the 70s, when I was too young and too dumb to play well, Coeur d'Alene Mines went from 10 cents a share to $65. In the latter part of the decade of the 80s, before that wonderful bull market that happened 91 to 96, I was able to finance 2 small silver companies. One, Pan American Silver at 50 cents. The other, Silver Standard at 72 cents. 6 or 7 years later, both of those stocks had crested through $40. So when I say that in a silver bull market, the asset class that performs most dramatically to the upside is silver stocks, that is an indication. I was vocally bullish about silver stocks in December of last year and January of this year, for the simple reason that there was so much hate concerning them on social media. I determined that from my own viewpoint, almost everybody who wanted to sell had sold, because there was no love, there was only hate. The consequence of that is that that subset of silver stocks has done very, very well, up about 50, 60% in the first, 7, 8 months of 2024. In direct answer to the question, about 2.5% of my total portfolio was invested in silver equities. That has become about 3.4, 3.5% of my portfolio, not because I've added more money to it, but simply because the prices of the small silver stocks has outperformed most other asset classes in the ensuing period.
Rick Rule highlights that while gold is important, silver mining stocks historically provide the most dramatic upside during precious metals bull markets. He provides specific examples from his career where silver mining stocks delivered exceptional returns, e.g., Coeur d'Alene mines going from 10 cents to $65, Pan American Silver and Silver Standard rising from under $1 to over $40. This occurs because the silver mining sector is small and can't handle large capital inflows during bull markets, leading to explosive price movements. Rule emphasizes that official inflation metrics, like CPI at 2.6%, may significantly understate real-world inflation, which he estimates closer to 7.5%. This is because official numbers often exclude critical expenses like food, fuel, and the cost of government taxes. He suggests investors should calculate their personal inflation rate based on their actual consumption basket, rather than relying solely on official figures. Rule also illustrates how market psychology takes time to catch up to economic reality, particularly regarding inflation. Drawing parallels to the 1968 to 1982 period, he notes that while inflation warnings appeared in 1968, public concern didn't materialize until 1972 to 73. When this realization hit, gold surged from $35 to over $800 per ounce. Rule suggests we're in a similar period now where gold will benefit once that arithmetic comes to be felt in the market, as people become increasingly concerned about maintaining purchasing power in their domestic currency.